Linked Annuities Act that I introduced with my friend Alma Adams. It's my hope that this committee can advance this common sense legislation in the coming weeks, has strong support of members on both sides of the aisle. Look forward to debating that, hopefully coming soon. Mr. Purwar, I want to start specifically with you. You mentioned the Jobs Act, 10-year anniversary. Know you're very familiar with it. I want to give you some time to maybe comment on areas that you think we can go further to improve that IPO on-ramp, make sure that there's more companies coming public, and they can do so in an efficient manner. Would love any of your thoughts on that.
Sure, I have some. I see Congressman Emmers here, but I'm sure we're going to get into his venture exchange bill a little bit later. I think that could be a nice piece of the puzzle. What the Jobs Act showed was that, that we can make some differences around the edges. What it also showed was that there were a number of provisions in the Jobs Act that a lot of people ahead of time, ex ante, thought were going to be taken up and be used, and they weren't. But other ones we didn't realize were going to be as important as they ended up to be. So, for example, the ability of companies to do confidential filings with the SEC has proven to be a huge success. It allows companies to go through that process. If they decide not to go through with the offering, it's not like there's some sort of stain on the company or whatever. Yeah. It allows biotech companies really like that idea because it allows them to keep proprietary information from their competitors, but then that information becomes public and enough time for investors to move forward. So, just as a general matter, I would encourage this subcommittee and the committee at large and Congress to come up with as many different ideas as possible because we don't know which ones are going to be used. Now, having said that, I think there's, venture exchanges are one potential way to go forward, that there's other sort of things you could do in that area. The other one is, I think opening up the accredited investor definition and to allow more investment in private companies is something, that we could do. And then, just anything in the IPO on-ramp, if there's other types of burdens and regulations to take a look at, 10 years later, are there new things now that are burdening companies? I mean, I'm fond of, there's what's called the pebbles in the stream analogy in terms of regulatory accumulation. The commission does a good job at looking at, on an individual basis, cost-benefit analysis, but over time, those regulatory burdens can go over time, and they're like pebbles in a stream, where each individual pebble doesn't stop the flow of the stream, but cumulatively they can, and you can't look back and say it was any one of those. And so I'd encourage folks to look back and say, well, what has accumulated over the last 10 years that could potentially be scaled back for these smaller emerging growth companies?
Yeah, I think the accredited investor rule in particular, just by definition, shuts out so many Americans. And we know that the bulk of the returns, or a lot of the returns of our fastest growing companies are now happening in private markets. So we're excluding minorities, we're excluding lower income retail investors from being able to get involved at the ground level at some of these exciting companies. I think it's a horrible rule. I would love to see bipartisan support around coming up with something more sensible. Sure, we have to protect folks, but good God, let's give them an opportunity. Mr. Pivovar, I'm going to ask for your quick thoughts on another SEC rule that has been considered, which is to require U.S. private companies to disclose more information as if they were public, but without any of the benefits of accessing the public markets. Do you have any concerns with that approach? Do you think it's the right approach? And how do you feel about it with respect to capital formation?
Yeah, I mean, I do have concerns. We obviously have a regime for public companies and a regime for private companies, and I worry about the unintended consequences from these, right? Obviously, if you overburden public companies, you're going to have more private companies, and I worry about the fact that these companies will just go overseas, and then U.S. investors won't have access to the potentially great growing companies and the entrepreneurs of the future.
Yeah. Well, I only have 30 seconds left. I don't know if I can get this out, but I have a similar concern with the ESG disclosures. And that I was talking to a friend of mine who works in the investment industry, and he said, look, this is a total giveaway to the private equity industry. Because what's going to happen is smaller companies who aren't going to be able to make or don't want to make those disclosures are going to have trouble making those disclosures. It's just going to be easier for them to sell. And so we'll see a wave of consolidation when I think we should be promoting more competition, more capital formation. Hope we have a hearing on that. Hopefully we can get Chair Gensler and others to come before our committee again. And with that, I yield back.
Gentleman yields back. Now recognize the gentleman from Minnesota, Mr. Emmer.
Thank you, Chair Sherman and Ranking Member Huizenga. I was pleasantly surprised, and I'm proud to see my bill, the Main Street Growth Act, noticed for this hearing. The Main Street Growth Act would allow the Securities and Exchange Commission to provide for the creation of venture exchanges so that small and medium-cap companies can go public through a more streamlined process. This bill passed out of this committee unanimously in the 115th Congress, and it passed the House as well. In fact, I'd like to thank Chair Sherman, Mr. Scott, Mr. Himes, Mr. Foster, Mr. Meeks, Mr. Gottheimer, and Mr. Gonzalez on this subcommittee for voting in support of this bill, and I hope to have your support again. Look, we have a capital formation problem in this country, and ultimately the compliance burden borne by government overregulation is making the initial public offering process unrealistic for a large segment of private American companies. This hurts everyday American investors the most, much like Mr. Pivovar and Representative Gonzalez were just talking about. Small private companies that need capital are at a disadvantage today because the trading and listing environment is geared so much for much larger IPO companies than it was 25 years ago. How do we know? The participation in the IPO process has significantly declined since the 1990s. Let's look at the facts. The number of IPOs declined more than 63% from the 1990s to the 2000s and has stayed relatively flat up to 2020. At the same time, the United States has doubled the regulatory compliance costs a business has to take on for going public in a traditional IPO. Just to give an idea, it costs an average of $2.5 million for a company to achieve just the initial regulatory compliance for going public, and then it's an additional $1.5 million on an annual basis thereafter. These are SEC estimates. In the past 2 years, we've seen a surge in companies going public through alternative strategies like SPACs, indicating that the traditional IPO process is not feasible for emerging innovative companies. The small startup IPO should not be on the superhighway designed for trading Apple and Microsoft. We need to move away from the one-size-fits-all SEC regulatory posture and allow the market to try new, innovative strategies. After all, capital formation starts when a company can list its shares on a quality electronic venue plugged into the full force of America's investment potential. I appreciate my colleagues' willingness to advance legislation that creates new exchanges tailored to small and medium-cap companies because exchanges are integral in the capital formation process, and America's capital markets are the envy of the world. The broader discussion at this hearing, I worry, centers around making it harder for exchanges to operate, which could impose barriers on the new, small competitors in the venture exchange space and ultimately make our capital markets less competitive and accessible. When we set up structures that allow for more companies to go public, we give the American people more access to our capital markets. We give them more opportunities to build financial wealth. Mr. Pivovar, do you believe that our legislation, the Main Street Growth Act, can eliminate some of the barriers currently deterring small, emerging growth companies from going public?
Thank you, Congressman. Yes, you pointed out the the streamlined IPO process, and so those are for existing private companies that do want to go public. In addition, as you point out, it also addresses the fact that the exchanges, the trading system is set up for the larger public companies, and frankly, the exchanges don't have the incentive to try to do innovative things, like you said, an experiment because of unlisted trading privileges. So in your bill, you would give exclusive trading rights to the venture exchange. Now, the commission looking at that, they're going to, it's going to be look at that very, very carefully, and we need to be very careful for that. The reason for that is you want to encourage the experimentation by the exchanges to compete with one another to make the market more conducive for that. And so it is my hope that would be the case. That you mentioned tick sizes and potentially doing call markets instead of continuous trading. But there's probably some other things the exchanges could do if they were granted that exclusivity.
Great point. And on that note, with a majority of American companies searching for alternative avenues from the traditional IPO process to form capital, such as SPACs, as I referred to earlier, or simply staying private, do you believe that there is a timely need for Congress to pass this legislation?
In a word, yes. Whatever you can do at Congress and the SEC can do to encourage more companies to go public at the appropriate time. You mentioned SPACs, right? Another one is direct public listings, and those are instances where you have companies that have grown very large in the private sector, and the only reason why they're going public is to have a liquidity event. They don't even need to raise capital at that point, so the more the better.
Thank you. Appreciate it. Thank you, Mr. Chair.
Thank you. I'll now recognize the gentleman from Wisconsin, Mr. Stile.
Thank you very much, Mr. Chairman. We've had a really interesting discussion today about the friction between exchanges, broker-dealers, investment banks, and asset managers on the liability question. And one of the things that I've been kind of pondering up here is have there been any instructive kind of global examples that we could look at outside the U.S. structure? In many ways, the U.S. capital markets are significantly stronger, bigger, and different than the global markets. But curious if that gives us any light into this conversation. And open up to you, if I can, Ms. Green, for a quick comment on that. And then I'd like to come to you, Ms. Sukuma, as well, if you have a brief comment on that.
Sure. When we look at the markets, my understanding is, and we can certainly come back to you and confirm this, but the regulatory structure in the U.S. is unique in these special privileges that it does provide to the exchanges, things like immunity, rules-based liability caps, and even on the SEC plans that we see, the exclusion of the of industry members. So clearly things that can be improved here in this structure, and I would defer to Nandini on her views on how the global markets are structured here.
Thank you for that feedback. Ms. Sukuma, would you like to comment?
Yes, with pleasure. I would like to start perhaps by just saying that across the world, across our members, and we have 300 odd, this kind of regulatory immunity is standard. It is the standard model. And why is that? It's because the exchange, by nature, the nature of its work, the nature of its business, needs to do things, canceling trades, invoking, volatility mechanisms, all these kind of things. And these are often unpopular. So they need to be able to do it. They're a neutral, trusted third party that operates markets. So they need to be able to have regulatory immunity.
Only because we're subject to the time restriction. Appreciate that comment. So you see certain consistency in that.
Yes, absolutely.
Mr. Pivava, do you see that as well, or any comment you'd like to offer on that?
No further comment on that.
No further comment. Let me shift gears slightly, if I can, because I think we've had interesting conversations. I'd like to go to you, Mr. Pivava, if I can. You commented in your testimony, in particular, an area that I have an interest in, that banning or restricting dual-class stocks would lead some companies to delist, I think was your testimony. I'm always concerned about proposals that reduce retail investors' options, especially when the purported benefits are questioned. And as you may know, the vast majority of Americans can't invest in many companies because they're not accredited investors under our U.S. rules and our U.S. structure. So we've essentially made a large number of promising investment opportunities off limits, but all to all but the rich, which seems a bit counterintuitive to me. We could get in the weeds if we had more time. But would any other bills attached to today's hearing lead to a reduction in the number of public companies, in your opinion?
I mean, I think anything that increases the burden on being a public company vis-a-vis a private company would, creates the incentives for either private companies to stay private or public companies to either go private or to simply move to other capital markets, right? I mean, what we forget is that there's not only a competition between the public markets and the private markets here, but Nandini's members are all competing to try to get listings around the world, and capital is truly global. So I worry about not only companies going private, but then also companies leaving the U.S. markets altogether.
Shifting more specifically to the accredited investor, do you think Congress should revisit the accredited investor standard?
Congress or the SEC has the ability to do it. They don't need additional authority, but I think potentially from this Oversight Committee's perspective, if you could direct the SEC to do something with that, to put the focus on it, I think that would be very helpful.
Thank you very much. Thank you very much for holding today's hearing, Mr. Chairman. I yield back.
Thank you for your brevity. I now recognize the ranking member for a 1-minute closing statement.
Thank you, Mr. Chairman. And yes, we are missing some briefings, and it's unfortunate that this was interrupted with votes. I appreciate the time, especially the additional time that all of the panelists have put forward. To kind of underscore my point from earlier, though, with all of the things that are going on, and Mr. Pivovar has highlighted as we talked about SEC actions, the SEC came out with another rulemaking today on SPACs. And it's like we can't even catch up to where we currently are or where they currently are. And the capacity and bandwidth of the SEC, much less everybody else who's being affected by all these things, is just getting stretched to the absolute limits. And we ought to be talking about that. Not that this isn't an important issue. Structures of markets is very important. It's what guarantees we've got the liquidity and the depth and makes this the premier place to invest in the world. But we are killing the goose that lays the golden egg here, in my opinion, and we've got to do better at tending to that. My time has expired. I yield back.
Recognize myself for a 1-minute closing statement, then the obligatory housekeeping. First, Mr. Piwawar, thank you for bringing to our attention that we may need legislation to provide for pilot studies by the SEC. The Republican side has constantly advocated to get poor and middle-class people the opportunity to make high-risk investments in low information securities. I would point out that the vast majority of middle-class and poor people's investments in the markets is through their interest in pension plans, plus, of course, mutual funds and business development companies. I thank Mr. Davidson, for an advocate of cryptocurrency, for explaining it to us clearly, that you ruin the whole purpose of cryptocurrency if you require them to adhere to anti-money laundering and know your customer rules. After all, cryptocurrency literally means hidden money,